Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. We have the one and only, and I dare I say, internet famous Todd Baldwin. How you doing, sir?
I'm doing great. Thank you for that introduction.
Hey, man, you've been all over the place, all kinds of articles, whether it be Business Insider, CNBC, all of those things. You are doing amazing things and really leading the charge. House hacking just was all over Yahoo Finance, which I always attribute to guys like you. So keep doing what you're doing, man. It's making a difference.
Thank you. I appreciate it.
Absolutely. So you asked me a question off air that I thought we should just record a video on. So
Yes.
go for it.
I will ask it again for the people, the good people of one rental at a time. Okay. So you've been in real estate for a long time, like real long. Old.
I'm old. Yes. I'm old.
And you've invested in a couple of crashes. And people think we might be heading for a crash now. So what's different about today than we saw perhaps last time in 2008 or in the 80s or, whenever those crashes were?
Yeah. So I started investing my own money in the early 2000s. So for people that don't have the timeline straight, that was before the last crash, really when financing was still legit. And I kept investing. I got up to 8 houses in about 4 years or so. So basically 2 a year. I had done some cash out refis, and, I recycled capital, but we got to 8 and we couldn't buy the 9th house. So again, I've experienced the crisis. I've seen crazy numbers. I've seen unaffordability. And obviously we did really well during the crash. We survived and thrived and we did all of these things. So this is a topic I wish more people would ask, frankly, because there's a lot of folks who own no real estate, who have never bought a real estate, that are looking at charts and going, hey, buddy, see where this chart is above that hump, so we must be in for a crash. I hear it all the time, and they say it so passionately, and they have such pretty charts. But today is not last time. So I guess there's a couple of things to think about. So first, let's talk about last time. What was happening last time in the run-up? And again, I want people to hear me. I got out, right? So I'm not one of these people who, bought and did all these things. I sold because I saw a problem. One of the first problems I saw was I was routinely declining tenants, because as a landlord, you occasionally have vacancies. You have a tenant box, certain credit score, certain income level, those things. And a lot of times people fill those out, Todd, and they don't qualify. What shocked me over and over and over again is, sure enough, a week, 2 weeks later, these individuals who I declined either for lack of credit or bad credit or lack of income, they were buying a home. Not only were they buying a home, Todd, but they were likely closing and getting cash back. Mm-hmm. Right. They were doing 103% loans. So I thought that might be a problem, right? Might be a problem. Then as I was looking for my 9th house, I would only buy positive cash flow, right? I call it yield because I want to know how hard my money is working. And I went back to the first property we bought. I wrote about it in my book, One Rental at a Time. And what I bought for 107 was 3 or 4 short years later being sold for 265. The problem, Todd, was the rent did not move. So what was cash flowing, a couple $100, now was negative. And that was all the houses, everything. And yet the hysteria, the mania was crazy because of these very toxic and ultimately, hopefully seen as illegal loans. 2 and 28s, 0.9, 1.9 for the first 2 years. And then they would explode to 8, 9, 10%. Because again, the people borrowing them were subprime. Mm-hmm. So they were, 10, 12, 13% loans. They were unaffordable. But the story was, and people bought it hook, line, and sinker, we'll just refi out. We'll just refi till we die, or whatever the mantra was. And as soon as the party ended, those loans, as they recast is what it's called, blew up. So what we had in that environment is a debt structure. And again, 50% of loans were adjustable rate mortgages with like 61% of those being these toxic pick a payment teaser loans. We don't have today. So that's the first difference. Mm-hmm. The debt structure that is anchored the housing market today is nothing close. People can go look this up. Black Knight puts out a lot of great metrics. 98% of the loans were fixed rate at the end of last year. We have seen ARMs tick up this year, but as of last year, just under 98% of the loans were either 15 or 30-year fixed. You don't become a forced seller when your mortgage rate is sub 4%, especially in an inflationary environment. What happened last time, Todd, and why we had what was called strategic defaults, and we won't this time, is because when the loan reset, nobody lost the home on the teaser period. They only lost the homes when they refi or when it reset or recast. Because what happened is that person at the kitchen table, I always go back to being a kid with my parents around the kitchen table trying to pay their bills. Parents around the kitchen table, it's $1,200, rent equivalent around the area is $1,800. Good to go. It's better to, it's cheaper to live here. Bingo bango, 2 years later, recast, it's no longer $1,200, it's $2,800. And now they're looking around going, I can rent down the street for $1,600 or $1,700. And then, oh, by the way, everybody else is doing this. And it's strategic default that becomes a thing. You live in your home for a couple of years, you eventually lose it. Very different today. Because we won't have wave after wave after wave of loans resetting. It's just not how the debt structure is today. Another difference. I mean, the differences are so obvious. I don't know why people don't pick these up. The biggest difference, and I would dare say a lesson learned for the banks and government from last time. Last time, if you got 90 days late, you were over 98% assured of losing your home. Banks are not doing this time. They don't want foreclosures, short sales, deed and lose, cash for keys. They don't want to do that. Look at what happened during the pandemic. All you had to go was online, check a stupid box, and you had no payments. Stick them on the end. 40-year mortgages. They will do everything they can to keep people in. Yes, there will be foreclosures. Yes, there will be short sales, but there will be nothing like that crisis. Again, I was buying then. I was buying in the depth of the crash where we had 2.8, 3.2 million foreclosures. It's not going to be anywhere close to that. Mm-hmm. The last thing to talk about is during the last peak, the interest rates were actually right around now. They were about 6%, 6 and an 8, something like that. What we are coming out of, and dare I say, is a problem. Because I think last time the Fed and government broke housing, right? Everybody needs a home, give everybody a home. Who cares if they can afford it? Problem. This time the Fed kept rates too low for too long. It created a problem, just a different type. We have interest rate lock-in, what I call supply destruction going on. We don't have forced sellers. We have forced stayers, right? Again, why would mom and dad sitting around the kitchen table now paying $1,200 in a $2,400 rent environment sell? They won't. And dare I say, if mom and dad lose their house or lose their job, which again, I think unemployment doubles, which means it will impact some, they'll get roommates. There's nothing here that it is so different. It is not funny. I think the Fed broke housing for the next 4 to 5 years, meaning transactions are going to be way off. I did the math today. So we did 6.9 million sales, existing and new homes last year. I think we do 25% less. It's about 5.2 million. Already this year, we are down to 5.9. So we're already trending lower. And I think it gets much, much lower from here. So I don't see any similarities. And I guess the last thing, just running this off, is last crisis, every real estate meetup I went to, people were screaming investment homes and this and that. This time it's very much more owner occupied, second homes. It's a very different buyer. People were flipping contracts last time. I'm in the Bay Area where I live. There were condo communities going on, and that condo would be sold 3 times before it was built, and everybody would make 50 grand. None of that's going on today. So I see very little similarities between this time and last, other than the government broke housing. Last time they broke it with the mantra of everybody needs a home. Add in Wall Street and their greed and stupidity, you get the housing Great Recession. This time the Fed broke housing because they kept rates too low for at least a year too long. And the housing market won't be the same for 4 or 5 years. But that doesn't mean, it doesn't mean pricing goes down. It just means owners don't sell. You only can have a housing crash when supply dwarfs demand. Mm-hmm. And even with demand destruction, which the Fed is doing today by taking rates up, if supply goes down by the same or more, the math doesn't add up. So I don't see any similarities other than the Fed and the government broke it both times. But yeah, again, ask away. I may have missed something. Let me know.
No, yeah. I think one of the biggest differences is that there was something terrible going on in the banking industry in 2006 and 2008. Mm-hmm. And they were putting together loans for, frankly, people who weren't qualified.
Oh, absolutely.
Yeah.
No, I mean, not even close. I mean, let's be clear. I rent to B and C tenants. But again, I have a tenant box. And if you don't qualify, you don't qualify, because I have to treat everybody the same. Mm-hmm. And then if I don't qualify you, but you can own a home and get 103% financing, I might call that a red flag. It's just me.
Oh, yeah. Yeah. So they basically put together loans that after that 2 or 3 year period, nobody would be able to pay.
No one. And I mean, the payments went up more than 100%. Think mm-hmm. about that. I mean, very few people on this planet could qualify for a mortgage and then suddenly see it double and still make that payment.
No way. Yeah, no way. And that's not happening today. So I think you're right. I mean, interest rates are going up. I saw articles the other day about how it could go to 6% or 7%, which is just, I mean, that's crazy. And I agree with you. Less people will sell their homes because they'll have nothing to move into.
Yeah.
If they have a good 3% interest rate on their current home, why would they sell and pay more for a home that has 6% interest? So yeah. I think you're right. I don't think it's going to be this big monster crash like in 2008. I think we could see some prices go down a little bit, sure. Just if there's motivated sellers. Mm-hmm. But you could also see prices go up. You really don't know.
Yeah, let's be very clear. I believe what we are heading into is a perfect environment for one rental at a time, or what I do. Because here's the deal. I only write great offers, meaning if my market, again, everybody's market's different, so do your own work. But if my market average is 6, I only write offers that yield 8% or more. And here's the deal. The seller doesn't have to say yes. Mm-hmm. But here's the deal. I can keep writing offers until a seller says yes. Mm-hmm. I don't need every house to fall 20%. I just need one seller to say yes to my offer. That's a very different story. Everybody, we will not have, I mean, because again, folks, I was doing this 20 years ago. I would drive down streets and no lie, half the homes would have an elbow in the street, in the yard. Mm-hmm. Listings beget listings and arms blew up. And we don't have the setup. Most people we have 3.6% unemployment. We have 5.2% wage inflation. We have rock solid lending with real down payments. Tell me where these forced sellers are going to come from. I mean, it's 3.2 million. I can't believe people are still talking about 3 million foreclosures. Black Knight, we peaked at, I think, 4.8 in the people in forbearance. We're down under 800,000. Of the 4 million, less than 2% went deed in lieu, foreclosure, or short sale.
Yeah. But you know what would happen, Michael, is if you happen to put out a video about how the real estate market will definitely crash, that video would get 5 million views and your YouTube would blow up.
Yeah. Again, I wish my character or whoever, first off, what I really believe is I wish I believed that a crash would happen, because I'd create that content. Mm-hmm. I just won't create something I don't believe in. Because again, I'm still growing. I mean, I'm growing my portfolio. You know, I'm going to be doing this for decades to come. I've told people you can go back and watch videos. I told people to refi 7-8 months ago. I refied apartment buildings into 30-year money, which people didn't know was possible. I told them how. I got 30-year money on an office building and an apartment at 399.
Amazing.
Oh, it's 30-year money. Mm-hmm. People didn't think it was possible. I brought them an answer. So again, I always talk when I'm doing, go back and look. I don't edit any videos and I don't delete any videos. So, hold me accountable. But yeah, I just don't see a crash. I just don't see the setup. I would love to call it. I would love, if Fresno went down 75% again, I'd own 1,000 units.
Oh yeah. Easy.
Yeah. Because I have a reputation. I've got some dry powder, not that much, but I raised $3 million last time. I could probably raise 30 million this time.
Nice.
Yeah, but I just don't see it. I wish I could. I wish I did. I wish I believed 5% that a crash was coming. If I believe that a crash is coming 5%, maybe I can create some content. I just don't see it.
I want a crash to come too, but for a very different reason. And that is, I want to buy my beautiful multi-million-dollar house on the water, but I'm too smart to buy a beautiful multi-million-dollar house on the water. So if it crashes and it gets cheap, then I would buy it. But right now,
yeah, I'm just curious. What's cheap for you? What are these? What would a cheap number be? We'll just put it out in the universe.
Like 2 million.
Okay. And what are they today? I have no idea what lakefront is. 5 million?
Probably like 5 to 7 million.
Okay. So you're talking 65% off.
Yeah.
Okay. All right.
I would buy it in a heartbeat.
You'd write that check. Well, folks, that's what the real estate, again, I'm talking residential real estate market has almost no similarities to last time. I will say that affordability is a problem today, and that's why I think real estate slows down. I could see real estate plateau. I could see real estate be very boring for 5 to 10 years. We've sucked in a lot of appreciation. The only way you fix affordability now is you let inflation raise wages. And that's where I think we are. I think we're in a wageflation spiral. I think the Federal Reserve is deathly afraid of wageflation and spiral, but I think that's where we are. So I don't know. I'm going to keep looking every day. I'm going to keep looking for that motivated seller. If a crash happens and I'm wrong, I will gladly admit it. And I will also buy a bunch of stuff. So there we go. Where can people find you?
Yeah. If you guys want to connect, you can find me on Instagram at Todd J. Baldwin.
Awesome, buddy. Thanks.